All right, I'd like to welcome everyone to today's Credit and FSA Program webinar series. Today's webinar is going to be financial risk, marketing risk, and impacts on FSA program compliance. This webinar is part of our Credit and FSA Program webinar series that includes sessions focused on a variety of Farm Service Agency program topics, including business planning, credit repair, financial and marketing risks, youth loans, microloans, and fractionated land loans, and understanding your rights of appeal. If you look at the handout section of your control panel, you'll see a flyer that contains all the information you'll need to join any of the remaining trainings in this series. You'll also find the slideshow being presented today that you can download and keep for later reference. I also invite you to visit our website at indigenousfoodandag.com, where you will find more information about this series and downloadable copies of the presentations. We will also post and archive videos of each webinar to that webpage. All attendees will be muted during the presentations. Attendees should use the control panel to raise their hands, or you can also submit questions using the questions dialog box. The presenter will answer questions at the end of the presentation. This series is possible with support from the USDA Farm Service Agency and the University of Arkansas School of Law Indigenous Food and Agriculture Initiative, who have joined to offer this important series of webinar trainings. I'd like to introduce today's presenter, Dr. H.L. Goodwin, who is the Senior Economist with the Indigenous Food and Agriculture Initiative. Dr. Goodwin is a professor and poultry economist at the University of Arkansas in Fayetteville, a senior economist at the Indigenous Food and Agriculture Initiative, and director of student networking and curriculum enhancement for Bumpers College. He joined the faculty of the University of Arkansas's Center of Excellence for Poultry Science in Agricultural Economics and Agribusiness in December 1997. Prior to 1997, he was the Agricultural and Food Systems Policy Advisor to the Minister of Agriculture in Slovakia from 1996 to 1998, and a Fulbright Scholar in Czechoslovakia from 91 to 92. Goodwin was on faculty of the Texas A&M University Department of Agricultural Economics from 1982 to 1995 and served as the Associate Director of the Texas Agriculture Market Research Center from 1989 through 1995. He received his PhD in Agricultural Economics from Oklahoma State University in 1982. And with that, Dr. Goodwin, I will turn the presentation over to you.
Thank you very much, Brian. I welcome everyone to our third in our webinar series, Financial Risk, Marketing Risk, and Impacts on FSA Program Compliance. The title is a little bit restrictive based on what I will actually cover. I'll cover more than what's indicated and in less depth perhaps on a couple of issues, but this will build on material that was done in the first webinar on record keeping, cash flow, and balance sheets. And so what we're going to do to begin this is we'll start with a brief overview of some of the FSA lending programs, information that we have, and then we'll step through that and begin talking about the risk issues. As you see here on our first overhead, these are the different kinds of farm loans that can be obtained through the Farm Service Agency. Direct farm ownership, there's some programs there. There's down payment for farm ownership. There's direct operating loans. You can see in this chart and refer back to our archive copy. The loan amounts, the rates and terms, and what is allowable for use of these loans. And so let's go to the next slide, Brian. Then you can see some operating loans here, emergency loans. There's some guaranteed loans, guaranteed conservation loan programs, and land contract and land guarantee loans. So these are some of the loan packages that are available through Farm Service Agency. In addition, in the previous webinar, we covered various types of other FSA assistance programs. I won't go into those, but I will mention some of them as we proceed through our slides today on risk. These basic applications, here are some links, and I might bring up here, I think there are 9 different forms that are necessary for basic applications and the links that are associated. I want to focus immediately on 4 of these. FSA 202 and 203 are 3-year financial and 3-year production histories. And again, record keeping cannot be underestimated in its importance. In order to qualify for any of these FSA programs, you must have financial or production history. Then specifically for today's presentation, what you'll really want to focus in on is the farm business planning. And as we proceed through the various types of risks that we cover today, you'll see how that will work into developing a farm business plan and also into estimating your future financial and production situations. Again, here's just some background information. You can make simultaneous applications for farm ownership loan and operating loans, and if you do that, you have to combine these in the same form. It's necessary that when you meet with your farm service agency representative in your county, that you explain what your exact plans are for your operation, and that way you'll get the complete packet that will enable you to be more expeditious in your application and in fulfilling those requirements. Here are just a few frequently asked questions. Some things that are covered, what types of costs that can be covered and what might be associated with that. Anything to reorganize a farm to improve profitability essentially is available. Purchase of equipment, for example, the example given here is converting from a conventional to a no-till operation, changing from a stocker operation to cow-calf, row crops to vegetables. Some people convert poultry houses to greenhouses. There's all kinds of things. So if you're in the business of transferring and transitioning your farm operation or the type of farm operation that you have, even for example going from conventional to organic production, implementing conservation type plans, any of those kinds of things are available to be covered on operating loans, and all of those are different ways to manage risk, which was the major topic of today's webinar. All these things are allowable expenses. It's pretty self-evident here. If you just think about anything that's necessary to meet your improvement of profitability or risk management, it's pretty much an allowable expense. Some more examples of things that are available for coverage. The last one I'll mention, loan closing or borrower training costs. There are some FSAs that actually require certain kinds of training for transition farming for young and beginning farmers. So these kinds of things are all covered. I might note the second one there, refinance of farm-related debts excluding real estate. In other words, you cannot use operating loans to deal with the real estate expenses of refinancing. Okay, and so now let's get into risk tolerance. That was a little overview on the kinds of things that will be allowable, and now we're going to peel back the curtain and look behind and see what types of risk there are and how you might manage that. The first thing we need to talk about is risk tolerance. How tolerant are you of risk? Are you someone that likes to go out on the edge and really try new and innovative things. Some of them perhaps maybe not being fully proven. Gambling for the larger return? Are you more conservative and like to do things the way you've been doing them and want to ease into adding additional risk? So we can handle risk in 5 ways. We can retain the risk ourselves. We can shift risk to someone else. That's usually done through contracts. We can reduce risk. That can be done traditionally in agriculture through, excuse me, through things like forward pricing. We can reduce risk by diversifying, and we'll cover all these things as we go through. We can self-insure. That's a little bit like retaining, except that when you self-insure risk, you actually put back money to protect yourself against the risk, whereas in the first time when you're retaining it, you're just taking it kind of as it comes. Or you can choose to avoid risk. Very few people are totally risk averse, which would be avoiding risk. So generally it's a combination of 2 or more of these 5 ways of managing risk based on your tolerance for risk. So what types of operational risk do we have? These are the 5 broad categories, and we're going to step through these one at a time. And as we do, be thinking of how these things would affect your financial situation and your marketing situation. Marketing being anything that involves price, quantity, storage, movement of product, any of the market functions. First, there's production risk. It's generally considered as husbandry or agronomic risk. There is marketing risk that deals with the sale and pricing of your product, financial risk, legal risk, and human risk. What are the human risks? We'll look at some of those things. Human risk would include things like if you have hired employees, worker safety, insurance for your personnel. If you have only family labor or unpaid family labor, you have a different type of human risk. Legal risk, many times, focuses around regulatory risk or liability risk. So let's look at those in turn, and we'll start with production risk. Before we get into production risk, and I think this is a good place to actually introduce this topic, there is a difference between risk and uncertainty. A lot of times people say, well, you know, agriculture is just so uncertain. We don't know what's going to happen to the weather. We don't know what our rainfall will be. We don't know our temperatures. I just want to clarify that things that are risky have probabilities that can be associated with them. Things that are uncertain do not have probabilities. Let me give an example. If, for instance, I worked in the field of field application of poultry litter or fertilization for many years, there are certain times when you should not be applying poultry litter. If the ground's frozen, if there's rain that would happen within 24 hours, so many feet from water sources, etc. We can know with some degree of certainty or probability rainfall. For example, if we look at rainfall in Arkansas in May and June, we know those are high rainfall months. We can look historically at weather patterns and get a probability of rain on a certain date over a 50-year period. You can do the same thing with temperature. You can do the same thing with winds. So all this weather information is available, and if you can convert that information into a probability, then you are dealing with risk and not with uncertainty. Uncertainty would be something like a government policy or world economic conditions. Those things are uncertain. But things like weather, pests, disease outbreaks, those are risky and can have probabilities associated with them. I list several things there. If you can go back, Brian, there's several other things there. Technology, genetics, input quality, machinery efficiency, those things affect variability in production, but typically are not probabilistic and do not have risk probabilities associated with them. They're things that increase variability or decrease variability of production. Okay, Brian. Let's talk a little bit about enterprise diversification. It used to be in the Corn Belt that most family farms had corn, soybeans, maybe some wheat or oats. They had cattle and they had hogs. Why did they do this? They did this to diversify their risk and to utilize their production. For example, they could feed the grain on farm to their animals and perhaps manage the risk of pasture or other things, manage the price risk and increase the margins that they could be recipients of with marketing their corn and their soybeans or their other grains in the form of meat rather than just taking it to market. So enterprise diversification has historically been a big way to diversify risk, combinations of different crops and livestock. It's become more customary, particularly since World War II, for off-farm employment to be the thing that producers use to manage their production risk. It's very, very typical for at least one of the spouses to work off-farm, if not full-time, at least part-time, and many, many times, particularly in smaller family operations or in livestock operations, let's say, for instance, poultry or swine that are somewhat confinement-based, to have both spouses working off the farm. So off-farm employment is a big area. Risk is reduced when income from enterprises offset low income from the other. It's just like having a stock portfolio. People typically have stock portfolios so that they won't have all their money in 3 or 4 stocks. They'd rather diversify that across many, many companies, and it's a buffer. You may not make as much money, but typically you won't lose as much money. And because agricultural producers are risk averse by and large, diversification is a good way for them to ameliorate the income risk that they face. Here's another basic one: crop insurance. Excuse me. Crop insurance is just like auto insurance or homeowners insurance or health insurance or life insurance. These insurance premiums are calculated based on probabilities, probabilistic risk. They have these tables that show, for instance, the probability in a certain county of having a hailstorm or of having above average rain at certain times, for instance, perhaps in harvest, or of having a drought that would affect your pastures or your cropping systems. So there are insurance premiums associated with this, and these are typically subsidized based on your qualifications, and generally they're run through the Risk Management Agency, which is a part of the Commodity Credit Corporation set up by law by the U.S. government, and it's funded every year. And the crop insurance premiums help buffer swings in yields and also now in prices. An important thing to think about when you look at crop insurance I've had many people in educational presentations say, well, you know, I think I'm not going to carry crop insurance. I never make any money off of my crop insurance. They should be very thankful. Crop insurance is to help you when something adverse happens. Isn't it nice that you've never had to use your crop insurance, would be my response. I hope I never have to use my auto insurance, but I'm sure not going to leave my driveway without it. Crop insurance should be viewed as a cost of production. It's an operating cost, just like fertilizer, diesel fuel, pharmaceuticals if you're in the livestock industry, feed. So it gives you an opportunity to have consistent gains. We don't like a lot of variability in our income if we're in agriculture because it's easier to manage things that are less variable. It helps you level out your cash flow. And again, I'd refer you back to the first webinar on cash flow. It gives you flexibility in your marketing plans, and there's a lot of crops that are covered. Now they even have total farm insurance, they have price insurance, they have income insurance. I would encourage you to look into options available through the Risk Management Agency and also local and all the local companies that Risk Management Agency underwrites for these kinds of things. Okay, Brian. Here are just some types of crop insurance. I'm not going to go through these and enumerate them in great detail. I would urge you again to contact someone in your local area, in your county. Many of these commodity type of insurance that came out in the last Farm Bill are based on commodity yields, and you see that APH in the middle. Yield guarantee is set using APH, actual production history. So if you don't keep records, you cannot participate because you cannot show your actual production history. You wind up using county averages, which if you're a good producer, you don't want to use the county average. You want to use your own averages. So again, importance of keeping your records. Catastrophic risk protection, that's a subsidized product in so-called NAP. It's available for non-insurable crops. Many times this is done for specialty crops, and you have to apply for this when you plant. You can't plant and find out a month later that, geez, it's going to be hot and dry and my broccoli's not going to yield, or my tomatoes are going to be wiped out. You need to apply for this stuff ahead of time. So again, FSA can help you with NAP. I urge you to contact your county representatives. Here's something, it seems like a digression, but it's really not. This slide is just put in here to get you to think about the magnitude of manufacturing employees by industry. This is for 2013. We'll have 2015 numbers available sometime in late February. But if you look at this, 31% of all jobs in food and beverage manufacturing are in the meat and poultry industry, 16% in bakery and tortilla products, 11% fruit and vegetables, 11% other foods, those are typically highly processed foods, and 9% in beverages. So this gives you an idea of the relative employment multipliers in these different industries. Meat and poultry obviously has the highest manufacturing employment because you have to do more to an animal to get it ready to be consumable than you do the other products. So that's the reason that's there. And I just wanted to point this out because we need to, as we explore using Farm Service Agency programs, other USDA programs, we have to keep in mind the relative importance that it has in the overall economy. Okay, Brian. What are some more production risk tools? Contract production. Anyone that is a hog producer or a poultry producer is used to vertical integration. Those people, and vertical integration, by the way, means that a company, a single company, either by ownership or contract or both, control all the aspects of production and processing, from planting or conception in the case of animals, all the way through to the consumers or to the marketplace. In the case of poultry and swine, it's done in a combination of ownership and contracts. There are many, many contracts. People who grow potatoes have contracts with potato processors, whether it be someplace like Simplot that processes French fries and dehydrated potatoes, or someplace like Frito-Lay that has potato chips. There are all kinds of production contracts. The barley growers are, barley is very contract oriented to the brewing industry. These contracts specify certain quality characteristics, but they also give a price guarantee, and they also give a quantity guarantee. Now, with these guarantees comes a loss in flexibility of how you can market product, and a loss in profit opportunities. So when we get to marketing, I will discuss a little bit. In fact, I'll just bring it up now because it seems to fit here better. Many people choose a blend of marketing approaches for their product. For example, grain producers may sell part of their grain to a cooperative. They may sell part of it in forwarding contracts. They may hedge a portion of it, and they may self-store some of it to play the cash market later, in hopes that they can balance their own risk and make additional profit opportunities because of the flexibility that provides. Of course, there are two sides to every coin, and they may well face the downside on that. Okay, Brian. What else can manage production risk? Genetically altered seeds and precision farming. I know that for many people, genetically altered seeds are an anathema. For many others, they're a lifesaver. There are all kinds of reasons to use genetically altered seeds, and there's many people who have reasons not to use them. I'm just putting this out as a way to help manage production risk. Precision farming is a very, very good way using GIS technology, micro-sampling of soils, etc. Also micro-sampling of soil moistures to allow you to apply your inputs most efficiently. It saves you on input cost. It enhances the environmental quality because you don't over-apply inputs. And it typically gives you higher crop yields because fields aren't uniform. It's just like the top of my head. Although it's pretty uniform that it doesn't have hair, there are spots that do have hair. And so the nutrient requirements from my body differ. It's the same way in a field. So the types of soil, the tilth, the levelness of it, whether or not they're wet spots, all impact crop yields. So it's really the precision farming is a huge area for additional improvement on managing your production risk. Okay, so let's look at marketing. Marketing is just a link between production and financial profit. In marketing, a market system happens and works when a buyer and a seller agree on a price that communicates the relative value of that product to the buyer and the seller. And so when do marketing risks happen? Well, we see there changes in weather, changes in policy, changes in, let's say, for example, food safety. Let's say there's a disease outbreak, avian influenza, hoof and mouth disease, swine fever, any of these kinds of things. These risks can be managed if you have an informed and balanced marketing skill set. So what we're going to go over are some of these tools that you need to have in your marketing toolbox. This heading here, managing market risk begins with a plan, is almost kind of a ridiculous understatement. Everything about your farming operation begins with a plan. If we don't have a plan, we cannot manage. So, and the first thing I like to talk to people about is make your personal plan initially. Before you know how your business is going to react to serve your particular considerations, you have to have identified those. So understand how much risk you can take. Be willing to increase or update your skill set, improve your technology, improve your management expertise. Marketing decisions need to be made independent, need to be made not independent of, but in conjunction with financial, legal, human resource, and production risks. So it's not something you do over here in the corner like you're playing a slot machine. It has to be looked at with your entire farm business in mind. And finally, develop a long-term marketing plan. You have to look at supply and demand. You need to know your regional prices. You need to know what your options are. If you're dealing with grain, what are the transportation costs of marketing into a different region? What are your futures prices? How can you use these tools? So these are all things that have to be in a long-term business plan, and the business plan needs to be very thoroughly thought out, looked at comprehensively with all the other 4 parts of your risk, and then it needs to be adhered to and evaluated at least annually and adjusted as needed based on your situation. What are some ways that tools that you can use in managing your marketing risk? Here are the different ways that you can do this. Some of these are price-based. Some of them are cash flow-based, storage, cash sales. You know, the functions of marketing utility are time, place, form, and ownership. So anything that changes the time over which a product can be marketed, the form in which it's marketed, the place in which it is marketed, and the ownership, those are all parts of the marketing system. So you can see here, you can defer cash, have deferred payment contracts, you can have fixed contracts for later delivery, you can base it off, you can peg it off of the basis contract. So there are all kinds of ways that you can do this, and this is something that you need to negotiate with the buyer of your product based on your 5 risk components for your operation. Why do I have this slide in here? Value added to the gross domestic product by ag and related industries. If you look at this, you can basically see the value that is comprised of ag and related industries. For example, in 2013, $800 billion. But you see of that, and I'm just extrapolating across there, it looks about $150 billion was directly to farms, about another $25 billion or so to forestry. The rest of that is value added. Food, beverage, and tobacco manufacturing, food service, eating and drinking places, textile, apparel, and leathers, all value added activities that are attributed to the raw farm product. So when we look at that, we're not just looking at the farm gate price. We're looking at adding value. And many times you can structure a marketing plan that would implicitly add value to the raw commodity price based upon whether you're providing time utility, form utility, space utility, or ownership utility. So these are just some things to think about when we're looking at our marketing plan. Financial risk. 3 basic components: cost and availability of debt capital, ability to meet cash flow needs in a timely manner, and the ability to maintain and grow equity. Most of us think about financial risk as related to stock markets or bond markets. This is financial risk related to your specific operation and what those risks are and how we can actually manage those. So if you go to the next slide, Brian. These are the things that we need to manage our risk. You must have well-maintained, accurate, current, and complete financial records. This is the only way you really know what the cost of borrowing operating money is, what the cost of acquiring capital for equipment upgrades or expansion, what it costs you cash flow wise. And I'll give a couple of examples here in a minute. And so you need to look overall at what kind of risk tools you have. We covered these again in the first webinar. I'd urge you to go back and look at that. But while this is up here, I just want to give you an example. As Brian mentioned in the introduction, I'm a poultry economist. When I first came to the University of Arkansas and started working in poultry, I found that many of the poultry growers needed to do certain maintenance and upgrades on their ventilation equipment, but the nature of the poultry industry is such that you expend money for 6 or 8 weeks and then you get paid in one lump at the sale of the birds in the house. So you'd spend money for 8 weeks and then you get a payment, and so that's when you'd make your mortgage payment on your house and when you would invest in those kinds of things. Many people would wait until their cash flow situation, maybe to be 2 or 3 flocks, until they could accumulate enough money to replace fan belts, fan blades, fan motors, etc. As ventilation pressures drop in a poultry house, performance drops and therefore your income drops. So what I tried to get them to do was to use an operating line of credit to allow them to maintain and replace parts as needed to keep their production up. That's an example of knowing how much it would cost you to borrow that money for operating or capital replacements, and then figuring that in to your bottom line. And what actually happened was producers that did this increased their income because they were able to maintain their production. Why? Because they knew what it would cost them and they could get operating capital. So that's just an example of the importance of these financial risk tools. Many of your lenders will give you lower interest rates if you're using crop insurance. Some lenders now won't even lend unless you use crop insurance. Why is this? If you have insurance, your risk of not being able to pay your loan payment is much lower. So that makes the interest rate they charge you lower. They want to make sure you have adequate liquidity, to have enough cash flow to be able to keep your operation going and pay them their loan payments. And the third thing here, and this is sort of a sore spot, but I'm going to just throw this out on the table: controlling and meeting family living costs. The best thing you can do for your operation is to take a realistic, honest assessment of your necessary family living cost and figure that into your operation. If you don't, records show, and my own experience shows that producers consistently underestimate their family living cost. Therefore, they over leverage and they're always in a cash flow squeeze. Please, please be honest with your family living costs and allow for some unexpected things in there so that you can continue to have your operation support your goals rather than you supporting the goals of your operation. Legal risk. I work here in the law school at the University of Arkansas. I'm not a lawyer. I'm an economist. People don't like to talk about legal risk. They like to not think about lawyers, laws, regulations, restrictions, penalties. Let me just say this. The best way to not have to deal with legal risk is to think about it before you start. Everything is filled with legal risk. And the four categories that we need to think about is business structure and tax and estate planning. We need to think about contractual arrangements. We need to think about liability, and we need to think about compliance with environmental regulations. These things have to be a concrete and visible part of any farm business plan, and they will most definitely impact everything else you do. So do not fail to think about legal risk. Here are some risk tools. Get your business structure right. Spend some money with a lawyer or a business consultant getting your business structure appropriate for your operation. Have written contracts. Wouldn't it be nice if we lived in a world where everything was done on a handshake? But let me just tell you, people you've known all your life, irrespective of your situation, may have things that cause them not to adhere to their agreement that they have, the gentleman's agreement. So have written contracts. It's just, it saves you, it saves legal problems, it saves money, it saves family relationships, and it saves friendships. Have written contracts. Make sure you comply with your statutory mandates. Don't cut corners. Report your taxes. Pay your obligations. Make sure you meet wage and hour and safety requirements if you hire people. Make sure that you treat your employees appropriately, like you would want to be treated. Make sure they're terminated appropriately according to the law. Training on pesticides, herbicides, all kinds of agricultural chemicals. Pay attention to these things. Many extension services have excellent worker safety programs. There's all kinds of resources that you can get through Farm Bureau, Farmers Union, other production agencies. So please pay attention to these statutory mandates and make sure you comply with those. Now here's kind of a, human resources it's a double-edged sword. They're both a risk and a risk tool. And so the answer to that is how you manage people and how plans and decisions are made. Make sure you have, if there are multiple people in the management and authority of your farm operation or your agribusiness, make certain you have clearly defined mechanisms on who does what, who is authorized to conduct what kind of transaction. Here are just some examples. People management. Your most valuable resource in business is the people that you work with. So, figure out if you're large enough to have job descriptions. Figure that out. Have a hiring mechanism in place. How do you find people when there's turnover? How are they oriented and trained to your business? How do you interact employer to employee? Give them appraisals. Anyone that has an off-farm job certainly gets an annual appraisal, and then give them honest feedback. Be open, compensate them as they're due and as you're able, and make sure there's appropriate forms of discipline for non-compliance and how you want your people to perform. And then I beat on this horse in the first webinar extensively. 65+% of all farms do not have a functional estate or succession plan. Estate planning is necessary. Look at it, talk about it. If you're going to have a family succession plan and an estate plan, get it in place, talk honestly and openly before a crisis occurs so that the emotion of the crisis is not involved, and it'll help you all a great deal. I recently went through, and in fact, tomorrow I'm closing out some estate things with my dad, and he had things planned, so it makes it a lot easier to fulfill their wishes after they pass, after a parent or a sibling or a spouse passes, if there's an appropriate estate plan in place. So, risk management. Let's do a risk management checkup. Do you have written goals? Are they reasonable and measurable? Can they be attained in your lifetime? And have you shared the goals with everyone involved in the business? And have they shared their goals with you? In business management and strategic planning, we do what we call SMART objectives. Objectives need to be simple, measurable, attainable. They need to have a time factor, and they need to be reasonable. So this is something you need to do to check your risk management. See what you believe, what you think, write it down, communicate it with others, get their feedback. Have you been honest with what you're willing to tolerate as far as risk? What risks are kind of like fatal errors? What risk can keep you from attaining your goals, and what risk just sort of delay them? What do you want to retain and manage yourself? Which ones can I shift or avoid? And here's a big one. What was your last insurance checkup? You know, we get dental checkups, we get vision checkups, we get physical exams. We need an insurance checkup for health, life, casualty, property, disability, long-term care, Medicare, Medicaid, and crop insurance. Have an insurance checkup at least quarterly, but for sure annually, to make sure you're current with the situations that are involved in your life situation and in your business situation. There's some great resources here. University of Minnesota has some fabulous resources. There are several webinar series that have been done. The NRCS has them. Merck has them. Just on and on. I think I have 2 or 3 pages here, Brian, of internet resources listed. Oklahoma State Ag Law Center here, Women in Agriculture. So there are a lot of resources available. Get into these, something like Ag Plan, and just slog through it. I think that was on, maybe there it is at the bottom. Get on Ag Plan and just go through it and be honest with yourself. Ask the questions. Go back to this webinar, to these slides, and really take an in-depth look. And if you can answer those questions, if you can have a handle on those 5 risk areas, I will assure you, you can comply to the financial and marketing risks that are necessary to meet Farm Service Agency requirements for any of their loan programs or any of their assistance programs. So thank you very much. Brian, I don't know if we have questions. I'm available to answer those at this time.
All right, thank you, HL. I'll just remind everyone that's in attendance that if you would like to ask a question, you can go to your control panel and you can raise your hand, or you can type your question into the questions box, and I'll just read it off to HL. While everyone is thinking about that, we'll go to our last slide here. And I just remind everyone that HL referred to some of the earlier webinars as he was talking today. If you go to indigenousfoodandag.com/FSA, all of the webinars in this series that have already been done are archived there. You can also see links to register for the webinars that are coming in the future. So if you go to that web page, you can see what's already been done and you can see what's on its way. So I would encourage everyone to go to that website and check it out. I'm not seeing any questions coming forward. Last call. Go
I
ahead.
would add, Brian, let me just say, if you think of questions at a later time, you can communicate them to us, I presume, via our website. Is that correct?
Yep.
Brian? Or they could ask them directly to me, hlgood@uark.edu. We've laid a lot of information out here in a pretty short period of time, so a lot of times we need to marinate on things.
Yeah, absolutely. And you can contact HL directly, or if you go to our website, you'll see an About Us tab there that has all of our contact information, and you can reach us by email, you can give us a call, you can reach us a variety of ways. Not seeing any questions, I will go ahead and conclude today's webinar. Thank you everyone for attending, and we'll see you next time around.
Thank you very much.